Last week, we went over exactly how to manage your IUL for maximum cash growth. This week, we're sticking with the IUL space and we're going over the power of zero. This is the Life Insurance Financial Education Podcast where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with NetWell Finance.
All right, the power of zero. In the IUL space, we're generally referring to not actually losing money in the IUL in a down market. Let's first go over, what does that mean? How can you not lose money in a down market?
The IUL carrier will take your premium payments. Those will go into the general fund. And what happens in that general fund is they're buying secure assets with a yield. And that yield effectually becomes the options budget should you choose to use one of these indexing strategies. And they'll buy call options on the indexes that you might choose. That's the general gist of it. And so the worst case scenario from the perspective of a loss is you basically lose that options budget. Those options expire worthless and you don't get any exposure to that upside. And that is effectively how they get you that zero when the market could be tanking completely.
So let me see if I can paint a picture since this is an audio podcast. I'm going to describe that in an easy to understand picture. The money that is in the general fund is essentially earning bond rates. Let's just say that that's 5%. They're going to take 5% of that general fund or to allocate to all the options that they're going to go purchase. That's your options budget. You can either take a fixed rate or you can say, take this options budget and put it into the market via call options. They're going to go buy call option. And at the end of that next year, that call option is either going to be worth money or it's not going to be worth money. And during the course of that year, the general fund recovers the amount of the options budget. So if the overall general fund is $100,000, they take 5%. That brings it down to $95,000. The bonds that they're investing in are going to grow that general fund back to $100,000. So the next year, they have another options budget available again. And they can do that every single year. So it's not magic happening behind the scenes. They don't require you to make or lose money with your index choices. They're going to go buy whatever the cost of those options are. Now, if that options budget can buy one full call option, you get unlimited upside potential. There's no cap. If it doesn't, if it's not enough because the option is too expensive, which is often the case with options against the S&P 500, you end up with a cap because they're going to sell the upside in order to get the price within the options budget. That ends up creating what we call a spread. You have a call option that's bought and a call option that's sold. That's a certain percentage out of the money, and that's going to determine your cap. So that's how it works. If the index loses money, if it goes down in value, you're not actually invested in the market. The options just expire worthless. And then whether you can make money again the next year, it resets at whatever that index value is for the new year. It's an automatic reset every year or every other year or every 3 years. It depends on what the point to point is for the index option you choose. So in any given year, the nice thing about being in the IUL is we're not really worried about a market crash because we just don't get a credit. Instead of getting credit, we get zero. And this is the power of zero. And what does it mean to an overall portfolio when you don't actually lose money in the market?
Yeah, I think the easiest analogy that people can wrap their head around is the numbers of a 50% drop. So if you have 100,000 invested in the market directly, and it takes a 50% drop, that will mean that you now have $50,000 of investments. in order to get back to that $100,000, the market has to have a 100% return. That is just the reality of the math. And that's the simplest analogy in order to really wrap your head around the numbers of it. And, that's significant.
Yeah, keeping with those numbers of 50% drawdown, I ran the math. And if there's a 50% drawdown and you get a consistent 8% compounding return each year after that, it's going to take you 9 years to recover and get back to a point where the amount that you originally invested is now back to making money. That can be difficult. That can be hard for a lot of people to stomach. Your good investors can be good at buy and hold, but it's the human element of emotion that gets injected into it that we have to be able to stomach that drawdown and believe that it's going to recover like it always has in the past and get over the feeling that this time might be different. Because I'll tell you what, every single time it feels like this time is different.
Yeah, and I think that's the big thing is these types of tools, like an IUL, like Whole Life, these things can help you. I think James likes to refer to it as your sleep number. These are things that can help you have peace of mind and allow you to sleep at night, even when the market is taking a tank. And that is something that when you consider for the fact that, yeah, there's oftentimes a pretty big snap up after one of these corrections. So it might not be that 9 years. I think it's an unlikely scenario. It's possible, but that snap up usually does not always fully account for that drop when we see these historical big events that have been huge crashes.
Yeah, well, 2001 was the beginning of the lost decade. So it has happened in the past where it's taken many, many years to get back to a positive number. Now, the people that had the chance to buy during the dip, they were pretty happy when it went back up. But the people that were all heavily invested before that, they were having a problem. And this is where the IUL shines as a supplementary or complementary tool to our actual investing in the market. In the IUL, we didn't actually lose money. In fact, if there was a 50% drop, we would start at wherever it is at the end of our annual point to point for the next year. So we could potentially make money the very next year while everyone else is languishing. Or if it's a multi-year drawdown, it's possible that we could lose money for 1 year, but then at some point it bottoms out and it starts to go back up. When it starts to go back up, we're going to participate in that right away. And it's nice to have that balance between some of our portfolio that might be at risk in the market to the downside and some of our portfolio that's not at risk to that market.
Yeah, and I think that's the real power of this is it's not just in a vacuum, you do one or the other. I think that both direct market investments and an IUL have a good place in most people's portfolio. And yeah, as James mentioned, that lost decade, that was a that was a pretty dire circumstance because you really had two events. It wasn't a single event that caused that lost decade. And really, when you have that sort of scenario can happen, and it is possible that it will happen in the future. And having a tool like an IUL, being able to hedge for those sorts of scenarios, maybe you have some sequence of returns risk. If that is you, I know there's a lot of folks. There's actually been some stories on this podcast where we talk through some of that impact of that sequence of returns risk that came to be. So I think that having a tool like an IUL, when you have that zero, the power of zero, protecting you from those big downsides so you can weather those storms of market corrections.
Now let's go over just a few more numbers. We talked about 50%. You get a drawdown of 50%, you need 100% to bounce back. We don't always see drawdowns of 50%. If there's a drawdown of 10%, you need 11.11% to get back to even and start making money. A 25% drop requires 33.3% to get to recovery. A 70% drop. This happens if people generally aren't invested in indexes, if they might be in individual company stocks. This can happen fairly regularly, but a 70% drawdown requires 233.33% to get back to even. Those are portfolio killers when you get massive drops like that.
Yeah, and I think that's one reason why most of your average people probably should shy away from some of those individual stocks, and doing simple index dollar cost averaging is going to help protect you. But some of those numbers that James mentioned, at 25, percent, we have seen those, and even in recent years we have seen those. Although we have had one of the biggest bull markets in history for the most part, but we have seen some pretty big drops in history.
Now, while we do enjoy that power of zero in the IUL, we do generally have capped upsides. So all in all, if the market continues to perform like it has in the past, an IUL will likely underperform even despite not participating in all those downsides. It will likely underperform all the upside that tends to happen in your major indexes in the market. But it's all about that sleep number that allows us to ride out the ups and downs of the actual market by having that diversification into some of these cash value assets that are not going to be correlated to that market downside. In this case, we're talking about IUL and what the power of zero does for it, but whole life can also serve that purpose.
So what these tools like an IUL or whole life give you is that opportunity to weather that storm, and keep in mind that you're going to get through it. And if you need to tap funds, you can. And sometimes it's not even just for emergency's sake. I think we talked about it in sequence of returns risk, is maybe you don't want to take a lifestyle hit and you can tap those funds to just continue to fund your lifestyle. There's a lot of flexibility when you have these tools in the toolkit.
So not only is there power in that zero that protects you from actual market losses, it also is what provides the backbone of what we call a volatility buffer. Because you're not participating in that downside, if the market and a large part of your portfolio is crashing, losing value, if you're in retirement, you don't have to tap into those funds that you might be forced to sell at half price otherwise. We can access the cash value, use that liquidity in those cash value life insurance in order to meet our spending needs while we get to allow the market to recover. So lots of ways to look at what that power of zero gives us besides just downside protection.
And I want to call attention to one more thing, because when you have some of these market-wide events, what ends up happening is it's not just the stock market. But if it's a stock market and whatever it might be, when you have access to something that has that downside protection, there is that just knowledge that you can capitalize on that downside. Warren Buffett talks about this a lot. When others are running, that's when you should be going after it. So you have that opportunity when you have something like the line of credit that you can tap inside of cash value life insurance to possibly take the opportunity to buy a business that might be struggling because of the economy, or go purchase some stocks that are down, or some real estate. There are options when you have something like cash value life insurance ready to go.
Good points. In 2008, when the real estate market crashed and the stock market crashed and banks were struggling, they tightened up all their lending. They closed lines of credits. They reduced home equity line of credits. The only people that could take advantage of the foreclosures and all the short sales happening in the market were people that were sitting on cash or had cash value in their life insurance that was available to go purchase these investments for pennies on the dollar. That wraps up this week in the power of zero. I hope you learned something. Next week, we're going to go over the 3 secrets of cash value life insurance. I'm not going to give you any hint on what those 3 are right now, so you'll have to join us next week for that. I appreciate you being here. I'm James Barber, your Oregon Cash Flow Pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance. And we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.